Hello and welcome to another episode of Copper Bottomed. It's been about 6 weeks since I did the last one. It has been a very busy time for me at Fitzroy Minerals. We're busy exploring a whole bunch of projects in Chile and Argentina. And of course, in late June, we put out the announcement that we are looking into the acquisition of Lundin Mining, which has taken up a lot of my time. I've also managed to squeeze in a quick holiday as well. But here we are, copper bottomed, a lot of change in the copper market in the last 6 weeks, lots of things to talk about. Today is the 28th. I'm recording this on the 28th of August. Yesterday, the copper price on Google was showing $4.28. I've just checked the LME market price, 9,373 to there's the cash to threes price. So it's about $4.25 per pound. Obviously, it's off a peak of whatever it was, $5.25 a pound a couple of months ago, and it hit as low as $3.92 a pound. So we've had this kind of huge unwinding in the copper price, but actually gradually things kicking back up or picking back up. Just on that, in terms of kind of the market price and the price action over the last, of the year really, the year to date, I think it can be characterized by a couple of things. Firstly, we've all known all the way along that Chinese housing demand and the property crisis in China has meant, Chinese housing demand has been poor. The data has been weak, which means that all of the commodities that are associated with the Chinese property market have been very, very weak. And in a sense, during the course of 2024, the Chinese copper traders were slightly gobsmacked by the amount of investment demand into the copper space during 2024 and the flow of funds into the sector. And that really was the kind of the driving factor. It was the flow of funds that took the price from $4 up to $5 and beyond. And really that was driven by the kind of the macro changes on the supply side, signaled late last year and into this year, the problems with Quebrada Blanca, the problems with some of the mine expansions, the cancellation, Cobre Panama. This is kind of the general supply side wobbles, large projects being postponed or mine closures, that kind of thing. And so that's where the Western funds decided to go long copper, which was slightly antithetical to the actual demand picture that we were seeing in China. Now, what's happened in the last 3 or 4 months since May is that the fund positions have unwound as the realization that demand in China is actually weak. But fundamentally, copper demand ex-China has been pretty strong, particularly out of the US. So what we've seen now is actually that the market is now tight again at the kind of the metals level as demand is matching supply. And this is why we've kind of seen this rise from $3.90 to $4.25 today, $4.28 yesterday, as well as a bit of dollar weakness as well. So that's the kind of the overall picture. Most commentators you'll listen to will continue to say that the supply profile going forward is poor. The long-term demand fundamentals are very strong. There's maybe some uncertainty about the short term, but structurally this is a kind of market that you want to be long of in terms of copper. Now, obviously, I'm not the only person saying it, and Lundin Mining and BHP put their money where their mouth was, in the sense by their announcement at the end of July. Here we go. This is the Lundin Mining news release. Lundin Mining and BHP to acquire Filo and form a 50-50 joint venture to progress the Filo del Sol and Josemaria projects. So this is a kind of $3 billion deal. BHP looking long-term into Chile. What a fantastic result for Filo shareholders. When you probably know that over the last couple of years, as this has been kind of range bound in this kind of $20 to $25 price range, I've been saying, kind of $3 billion is a lot of money to spend on an exploration company. But when there's a shortage of really good assets, and when there is companies with strong balance sheets and long time horizons, they were willing to pay this premium. It was kind of a 30% premium. It really took it from $25 up to $33. I mean, what a result that is. So well done, all of the Filo shareholders. Congratulations. And this is actually, I think, perhaps even more important for Argentina than it is for, the short-term money, of course, well done shareholders, but I'll come on to the kind of the impact on Argentina in a bit. In the last 6 weeks or so, a couple of reports have come out. Perhaps an interesting, the most recent one is one by Wood Mackenzie. They put out a monthly Horizons report, which is worth looking at. This one, they focused on supply. They focused on supply security, and they look at the energy transition without using China. And they say, well, forget about it, basically, is their key conclusion. It's going to cost you $85 billion, and why would you bother? They've got this great chart in there, figure 3, their copper smelter industry cost curve. Look at that. So the bottom 45%, or rather 45% of the global smelting capacity sits in China at an incredibly low cost base. So there's absolutely no point anybody building a new copper smelter anywhere, because you're just going to face these terrible economics relative to China. You might as well just ship it to China. And in fact, I've seen this in Chile. So we've Enami, one of the state companies that deals with smaller production issues in production in Chile. They've closed down 2 of their smelters simply because there's no competition. It's much cheaper to truck your concentrate or ship your concentrate to China and get it smelted there. So we are stuck with this smelter capacity. And in fact, China has overbuilt, which means that the smelters are now competing with each other. So your smelter charges are incredibly low. So not only is it a low cost system, but actually the treatment and refining charges that you get charged for these for your products in China are very low as well. And so Wood Mackenzie summarized it by saying the world cannot decarbonize without copper, which is a key component of electrification. True that. Absolutely. And then amid efforts to secure minerals for the energy transition and achieve climate goals, demand is set to surge. That's what we know. And they're saying that they're looking at a 75% increase in copper demand by 2050 to 56 million tons. And remember, we're kind of a 26 million ton per annum market, of which 5 million tons is recyclable, of recycled material, secondary material. So 21 million ton mine production. And they're trying to grow that to 56 million tons by 2050. It's just crazy what is required in terms of copper demand. Wood Mackenzie go on to say that compromise is key. Protectionist measures to secure raw materials for geopolitical reasons ignore the complexities and current efficiencies. Here we go. These are the efficiencies of copper market supply chains. So basically, we're integrated with China for the next foreseeable future. Right. What else? A report I missed in early July was an update by S&P Global of their, they look at kind of major copper discoveries, that they do kind of regular research notes, S&P Global. I thought this was a really interesting one. They say that the new major copper discoveries are sparse amid the shift away from early stage exploration. So we know that it's sparse. You'll probably recognize this graph because it's kind of been kicking around for a number of years, although this is the most recent update, June the 11th, 2024. And look at this tail. I mean, I've spoken about the dearth of kind of major discoveries in the last 15 years before, but that is it in graphic form. And the blue line is copper exploration budgets. And I think what S&P are saying is that actually a lot of this increase in expenditure has gone on brownfields exploration rather than necessarily true greenfields exploration. And so their headlines, if you go through the report, the various headlines that they include are: the focus remains on older known deposits. And of course, one of the best places to find new mineralization is in the where there's old mineralization, around an old mine. And that's very much what I'm doing with Fitzroy. I'm looking at extensions of known mineral systems. At Polymet, for example, it's a known high-grade system, just a continuation of that. And the project that we're looking at to acquire, the Ptolemy Mining project, there was an old mine there. So, the best place to look for mineralization is within the site of the headframe of the old mine. Latin America remains top region for discoveries. Again, I like to think that that's what I'm doing at Fitzroy, but come and have a look at that separately. Africa dominating the past decade, and really that is Robert Friedland and Ivanhoe Mines and Kamoa-Kakula and the Western Foreland discoveries. Look at these. That's 25 million tons of contained copper that they've discovered. And then S&P Global reiterate there's a looming near-term deficit. Absolutely. They also include this chart which showing the average year, the mines, the timeline from discovery to production. They are now saying that the most recent sample set is 17.9 years. So you're talking 18 years for a mine. These are not just copper mines. These are just kind of mines in the S&P Global database. So we're looking at 12 years, over 12 years for discovery, exploration, and the studies, and then up to 2 years waiting time after your feasibility study. Remember, that's financing and permitting, and then 2.3 years in terms of construction. Now, I would say that when it comes to copper, when you're dealing with these big infrastructure projects like a low-grade porphyry, it's not 18 years that you're looking at. It's probably 25 to 30 years that you're looking at. I mean, look at Resolution in Arizona. That's 30 years in the making. And if you go back to the tech results call from a couple of quarters ago when they're describing the multiple major infrastructure projects that are associated with their QB2 expansion or development, Quebrada Blanca 2 in northern Chile, it's port, it's road, it's electricity and water and all of those kind of conduits. These are all major projects. You've got the concentrator itself up at the mine site. You've got the road infrastructure. You've got the camp infrastructure. You've got the pit infrastructure. All of these kind of parallel major infrastructure projects, they just take a lot of time to get right and to build. So it is very hard to do them all sequentially and to get the permits for them all sequentially. In parallel. That is why low level, low altitude, good infrastructure projects are of high value. I mean, if you look through this list here, Kamoa-Kakula, Western Foreland, that's okay. Western Foreland deep, but Kamoa-Kakula is in production. They've got the infrastructure. That's fantastic. Codelco, I don't know much about these two Antofagasta projects. Winu, yes, going well, I think. Codelco, those projects are always slow and they're going to be capital constrained. GT Gold, I'm not sure about that. It's Porvenir in southern Ecuador. That's that's way in the queue behind Cascabel, which is going to take time. Qatar Mining, crikey, I'm not sure about that. Coro, Marimaca. Yeah, that's going to come out. That's going to be in production. That's low level, not a problem. Lundin Mining, I don't know enough about those two. And Chalice, Julimar, I mean, that's a PGM project. I don't think that's going to be coming out of the ground anytime soon, just in terms of the market there. In the deficit coming up, there's going to be a real premium on those projects, which are shallow, easily developable, high grade, don't have this kind of major, massive infrastructure. You're not talking about billions of tons, which are going to take 25 to 30 years. Again, that's one of the reasons why I like Polymet within the Fitzroy portfolio, because it's super high grade gold and copper. But you can come and look at that another time. Right. We've had a few results come out. I've just taken a snapshot of two of these, the big boys. One is Freeport. They did a conference call in late July, and they, of course, note US demand remains strong, and that's really kind of picking up on the theme of copper demand coming through. Weak property sector and economic uncertainty in China. Yes, we've known about that all year, and actually that's just kind of playing out. Favorable medium and long-term fundamentals. They're not the only group that are saying that. I've mentioned that before. And then demand acceleration supported by the secular trends of decarbonization, electrification, technology, and connectivity. AI obviously is in that bracket there. Freeport talk about the supply limitations and copper's physical attributes as well. So that's the kind of the general summary from one of the headline slides. Now, what I found quite interesting was on slide 6, so quite early on into the presentation, Freeport is talking about the America's leach innovation initiatives. They talk about low cost and high value, and they're targeting copper in stockpiles unrecoverable by traditional leach methods with precision operating techniques. Okay? And they go on to talk about a bit later on, it's kind of their part of their strategy. The first thing cab off the rank they talk about is the new leach technologies Americas, leach to the last drop, sustaining initial target of around 200 million pounds per year. That's about 90,000 tons for those that work in metric. High probability of increasing to 300 to 400, so kind of 150 to 200, 145 to 180,000 tons per annum in 2026. That's kind of a good small mine or medium-sized mine, driving innovation towards 800 million pounds per year, so 300 to 350,000 tons per annum of copper, which would be a good-sized mine, and that's what they're really driving over the next 3 to 5 years. Interestingly, however, every man and his grandson is coming out with their kind of claims of new leaching technologies. You've got Rio Tinto with their BioLeach Newton. You've got you've got Atalaya with Elix. You've got Jetty Resources with their proprietary technology. I keep referring back to a 2019 report done by the Catholic University in Chile, in Santiago, that said all of these things, they get started and they work well at the lab scale and they work well at the pilot scale, but they're really, really hard to extend into the kind of industrial scale arena. Now, obviously, if you've got this supply deficit and if you want metal prices to kind of stay relatively normal, you need this kind of innovation to come through. However, it's going to be tricky because you can't change the physical parameters and the chemical parameters and the pressure environment without inducing cost. And if you want to increase the pressure, you've got to do pressure oxidation. If you want to increase the temperature, you've got to add energy. So you've got to add heat, you've got to add pressure, or you've got to add reagents. All of those come with a cost. So I just cannot see how you can, with kind of low cost standard oxidizing agents like salt, for example, which is traditional and has been used and applied very successfully across Chile. I don't understand how you can actually have a kind of a technological breakthrough without having a cost breakthrough as well as an increase in costs. And I was so curious by this and the fact that they're actually talking about this being the best return on capital that I went and I listened to the conference call. And guess what? It's the precision operating techniques which are actually making the difference, not the innovative leach methods. So what they're doing is they're using drone technologies and they're using new drill holes, and they're basically trying to improve the kinetic pathways, the permeability and the porosity of the existing leach pads and stockpiles by using drone technology and smart irrigation. So actually what they're putting in is physical infrastructure to get the leaching chemicals in contact with the metal, and they're using a bit of AI to help on that. What else is of interest in the Freeport news release? Well, I think their slide 9 is pretty telling. So these guys, the largest copper producer in the world, public, they are looking to grow from 4.1 billion pounds to 4.3 billion pounds over the next 3 years. And remember, a lot of this estimated growth is coming from the new leach technologies, and a lot of that is coming from the innovation in progress, which I kind of question. So I wonder actually if this is not just going to be flat, and that's not a punchy growth profile at all over the next 3 to 4 years. And actually, if you look at the gold sales are actually falling, and okay, moly's increasing a bit, but in terms of profitability, these guys, in terms of metal equivalent, are not necessarily going to be knocking it out of the park. So again, really hard to be differentiate yourself from the crowd when you're a producer. But there we go. I put that out there. And again, weak copper growth coming. Right. Another company that put out some results were BHP. I haven't had a chance to listen to the conference call, but here are some summaries from their presentation. First of all, they said that they delivered 9% copper production growth, to the end of June 30th, with a further 4% expected in financial year 2025. So that's over the next 12 months. That's pretty great. That's a pretty good result. And they're saying that the Chilean copper growth pathways are defined with attractive expected returns. So they're basically saying, we like the returns that's going to come from our big copper assets in Chile. Their strategic view is that they want to be in commodities which are positively leveraged to global megatrends, population growth, urbanization, increased living standards. This is very, very rarely discussed, but is a huge driver. And then the energy transition is their fourth. And this is what the Western media talks about most of the time. But these three things, population growth, urbanization, and increased living standards, that is going to be the key driver to copper demand, in my opinion. The strategy says in those commodities, they're looking at organic growth and delivering value to shareholders, and they talk about Chilean copper pathways back to 1.4 million tonne per annum. So actually just kind of trying to maintain growth or recover levels. They've got an aspiration of copper in South Australia, and they've got the potash, and they've got the iron ore. And then you look at the, much later in the appendices, you look at the return on capital employed by asset, and the West Australian iron ore, I mean, look at it. You know, they're going to deploy $19 billion worth of capital, and their return on capital employed is 60%. These are just monster assets. And then you've got Escondida, which is the largest copper mine in the world, at whatever that is, 27% ROCE. Antamina, fantastic in Peru, that lovely mega skarn. And then you think of kind of copper South Australia, you've got, you know, that's pretty marginal stuff down there. So BHP, they're looking at 1.7 times demand growth. Remember that S&P Global, we're talking about 1.75 times, or was it Woodmac, we're looking at 1.75 times. So kind of 70 to 75% increase in copper demand over the next 50 years. And BHP actually includes data centers. Here we go, AI. They've got a chunk in there for that. Economic growth, energy and transition, data centers. Right. Looking more specifically at Chile, they're doing a mine site tour in November. That would be a fantastic trip to be on. But they're looking at expanding their existing facilities, working on their existing facilities. They're kind of debottlenecking. This is the kind of the lowest cost of capital. And then potentially some new facilities. And they're looking at leaching with BHP and third-party technology with new supporting infrastructure. And leaching. Everybody's at this leaching stuff. But when you come to their growth options, actually, if you look at where they are today, 1.3 million tons production, and they're looking at production declines, they're trying to offset that, market guidance for the next couple of years, and then they're looking at 10 years out, 1.4 million tons of copper produced, and that's barely any growth. And then they look further potential leaching. So, you know, all the biggers like Freeport are saying they're flat. BHP saying they're going to be flat. You know, I've seen reports saying that the copper production in 2030 is going to be back down to the levels of copper production in 2018. So the the deficit is growing. And well, they talk about, here we go, full sal is the word for their leaching. So I mentioned earlier that they're using salt in many leaching environments in Chile, and it looks as if BHP are going down the salt route as well. So it's incremental, it's not transformational. You're going to get increased recoveries on your oxides, you're going to on your transitional elements, but you're probably still going to struggle to leach the chalcopyrites and get economic returns on those without a transformational change in the copper price, which should be coming if you read the tea leaves in this and in all of the reports coming out. Right. I get my weekly summaries from the junior mining. They've split it out now. They're actually starting producing ASX summaries as well. I had a look through all of these. There wasn't actually enough for me to want to get into the nitty-gritty in any of these. So Aurelia, the Peak Gold Mine, they're a producing company, and that's kind of an in-mine resource. They started these kinds of things. Investigator, they're a copper company. They're a silver company. 28 meters at 0.21, not really worth reporting. Entree, this is a $300 million company, Canadian, great results here. Their share price is kind of steadily keeping up there. I like this company. They're going to be the Hugo North extensions development is actually coming this year. They've been promising development for decades. Nothing's happened, but now we're actually getting close to it. So I really like Entree. DLP, we've spoken about them. Benson keep hitting some good stuff. 29 Metals, I thought 228 meters at 1.2% was good, but then I went back and I looked at the project, and they're a new company that came onto the market 3 years ago. $270 million market capitalization. I think they're struggling to, I think it kind of probably came out with too high expectations and are struggling to backfill the valuation, if you know what I mean. Sandfire, good results, but that's a big old company. Whereas Aldebaran, more good intersections in Argentina. Brixton, huge low-grade system there. Arizona Metals, yes, good grade. Very weird reporting in that company, so won't really talk about that. Metals acquisition, more good grades. I think we've touched on that. Yes, those are the guys drilling the old mines in New Brunswick. Slam exploration keeps popping up with a few results here. 65 meters at 2%, 35 meters at 1.25, 60 meters at 1.2. Yeah, good results from Slam. I went and had a look at the market capitalization. It's a $2 million market capitalization company. Interesting results. The company just needs to kind of sharpen up a bit. The presentation, the website, was like, yeah, come on, guys, you can do better. Right, so I'm not going to talk about any of these guys per se. American Metals West, and of course their Aston Bay Holdings, the same outfit. They keep finding copper in Nunavut, which is good. But for me, the two companies that really caught my eye, one was American Eagle, and the other is Arizona Sonoran Copper, because Arizona Sonoran put out a PEA. They got a market capitalization of $188 million, and the share price has recovered nicely from $1, whatever it is, 25 up to $1.70. Maybe that's, yeah. So that's a good old recovery in the last couple of months. They put out a PEA for the Cactus Open Pit project, and it's got an IRR of 24% and an NPV of $2 billion US, 2.77 Canadian. And various people asked me to kind of have a look at it, and I've got a relationship. I've spoken with George a few times, George Ogilvy, the CEO, on Crux interviews, and a couple of things struck me, and I haven't had a chance to speak to George, and maybe I will. First of all, the PEA supersedes the previous released pre-feasibility study in all respects. So if you go back through the history of the Cactus and the history of Arizona Sonoran, it can be a little bit confusing because there's been various studies put out, and then the exploration target grows, and then there's a new resource, and then they do a study on the expanded resource, and then they advance the work in one area, and they produce a pre-feasibility study, and then the resource grows again. So what we've had now is we've had a new resource to cover Park Celia and Mainspring and the kind of the wider area. They actually published a pre-feasibility study in February. So, there a lot of work went into the pre-feasibility study, and that was published in February. And this is the table from that pre-feasibility study here over on the left. And then 6 months later, out comes a preliminary economic assessment on a wider thing. And George, the CEO, makes some lovely flowery comments about how great it all is. And he goes on to say, we now look forward to completing metallurgical programs and the infill drilling to support a PFS expected in the first half of 2025. Okay, and they continue to work with our partner Newton Technologies, a Rio Tinto venture, which is bioleaching. That's their shtick is we're going to find a new revolutionary way to recover copper from sulfides, from chalcopyrite, through bioleaching. And again, the jury is out on that. I know there's a huge amount of information here, but what's interesting is that the throughput is up by 40%. Annual crusher throughput is 29 million tons, whereas in the old one, I think it's just from my notes, it's kind of about up 40%. Now, what's interesting is that if we go back to the early iterations of their studies, kind of capex was about kind of $150 million, and then in this one, the initial capital here is 515, and then the initial capital here, 6 months later, for a much bigger project, is only 668. So there's been a whatever it is, a 20% increase in the capital, but a 40% increase in the throughput. I don't know if that's going to hold up. Remember that these PEAs are to minus 25 to plus 30% accurate on their costs. So maybe if you increase the capital cost by within that 30% margin, it might be kind of slightly more realistic, because remember, this is a very preliminary study that they've done. And then the other thing which really struck me is that I know that the G&A on a mine, on a small mine, is going to be something like 10 million US, and maybe on a mine this size it might be $15 million US. But here, if you look at their G&A cost for $50 million total over 31 years of mine production, here we go, that's $1.6 million per annum. Now, I think that's kind of out potentially by an order of magnitude. You know, that could be $16 million a year, or maybe $12 or $13 million a year. But I mean, be conservative, call it $16 million a year. Your G&A cost on per pound of copper is not 1 cent, it's actually 10 cents. But if you actually come back to their pre-feasibility study over here, look at that. The G&A cost is an order of magnitude higher than in this PEA. So, you know, that's 12 cents per, that's per ton, and this is per pound of copper. So I'm probably not looking at like for like. Sorry, no, I'm definitely not doing that. But anyway, if you stick to kind of 50 million tons as the total over 31 years, that's $1.6 million per year. It's more likely to be $16 million per year. Very early days. I like the company. They've been well rewarded for their work, for the resource expansion. George is a good guy. I think these numbers are very, very early, probably pretty light. I would expect that their mine cost is pretty light. Oh, I went and had a look at the operating cost per ton, and they're down at around $2.2 per ton on an operating cost for mining, but they're leasing their trucks. And so what that means is basically they when you're leasing, you include the cost of the acquisition gets put into the operating cost, whereas the $2.2 is more like an owner operated, so they're not including the acquisition cost of the mining fleet. So I think they're light on the operating costs. I think they're light on the process cost. They're definitely light on the G&A. The market's given them support. Interesting. PEA, early doors, very loose numbers, plus or minus 30%. I think you'd probably, if you're going to model this, you'd want to put up those costs at least 30%, if not more, to see where you get to. And that's before we even get into kind of any questions about leaching and reagent cost and acid consumption. Good. Right. Now, the next company is American Eagle. I own a few shares in this. Disclaimer, I bought a few shares. I'm down, of course. You look at that share price there. I think I bought it around here on the way up, around 60 cents, because I just thought that they were onto something. I find this really, really, really interesting. You know, they're a pretty small market capitalization. They're $60 million now. They were up as high as close to $100 million Canadian. They're exploring around the Babine porphyry stock, and they've got some good results in the past. And this is quite a big zone. Look, this is a 500-meter bar here. So this is about kind of 800 meters north-south. Now, I think they talk about it. Here we go. Strike length of 750 meters and a width of approximately 400 meters. So this is the kind of the mineralized zone in here. Now, they published drill results on the 19th of August, and the market thought, oh, we don't like that. And everybody, not everybody, but there was a significant amount of selling. curious because gold is the kind of the topic du jour. It's the hot commodity, and also if you go and look at the table of these grades, there's still kind of, even though this is a gold zone or a golden rich zone, and this is hole 23 and this is hole 21 in here, there's still copper in there. These are still running kind of 0.3s, 0.35% copper. So it's not as if this is not a copper, not a copper hole. Perhaps it was a mistake to call it in gold equivalents. I don't know. I mean, it's hard to say. That I prefer seeing kind of the copper grades and the gold grades separately, and it might have helped here, but essentially this is gold and this is copper and gold here, and this is copper and gold here. It's basically a big mineralized system. They talk about, I mean, look at this. This is 175 meters from surface of 1.3 grams gold, and I think that's kind of 0.7 or 0.8% copper and 0.8 grams gold and 0.3% copper in that kind of zone there. Really, really, really interesting geology. They say the gold zones were drilled in different directions, and each returned well over 100 meters of mineralization from surface. They increased the gold zone's size by extending it to depth and to the north. The company believes this near-surface high-grade gold and copper resource will be vital to unlocking the economic viability of the NAC project. Yeah, mineralization from surface, good grade, dig it out of the ground, make money. The expansion of our high-grade continues to impress. Substantial volume of copper, gold mineralization. It's not a separate system. And then it couples with the unique infrastructure advantages, gentle terrain, drive on year-round access for drilling from a logging cut block, and proximity to full-service towns and a major transportation corridor. That's what you want. Open pitable, good access, year-round, major advantages relative to its porphyry peers. And these holes are the first few results of the program. So what is the program? They're doing 15,000 meters to focus on the main zone by continuing to link, better define and expand upon the north copper and the south gold zones and associated mineralization to the west. So they're doing the north zone, they're doing the south zone, and to the west. So basically they're drilling in here. And remember that they hit good results, 900 meters at 0.5% copper equivalent, 300 meters at 1% copper equivalent. This is a big system. I think this is really illustrative of the market expecting exploration just to be linear. Yeah, every hole, every news release got to be better than the last one, or they're just going to bail on it. This is a good group of professionals doing good work, hitting mineralization. Well done for those that are buying stock at these levels. I think that trend is that way. From bottom left to south to top right, southwest to northeast on the page, so to speak. Yeah, I look at the work that they're doing, and I think this is the kind of work that I want to emulate within Fitzroy Resources. Make sure that the mineralization is close to surface where possible. Get it near infrastructure. Try and delineate economic resources. I'm not so bothered about the copper grade. I am interested in metallurgy and simple mineralogy. And if you speak with Charlie Gregg, very much the same thing, or indeed with Stephen Stewart, the chairman. Very focused on economic mineralization. Keep going. Good stuff. Right. I think that's probably enough from me for today. I look forward to the next one. I am, as I said, absolutely flat out with Fitzroy Minerals looking at this acquisition of a really interesting project in Chile, or the potential acquisition of that. So keep your eyes posted to Fitzroy Minerals for news for economic copper and gold projects. Thank you very much. Bye for now.